Good afternoon, everybody. Thanks for spending your lunch hour with us. I'm Chuck Gerald, a partner at Allen Matkins, a real estate firm here in Los Angeles. And we've been in the real estate business for 40 years now, and we're really excited to be talking about crowdfunding and its impact on the real estate industry. We are thrilled to have two distinguished panelists to talk to you today about challenges, risks, and solutions in real estate crowdfunding, and I'll bring them up now. First, Michael Episcope of Origin Investments. He's joining us from Chicago, Illinois. We'll probably see him back here in the Dodgers-Cubs NLCS. But please welcome Michael.
You need one more.
And Ryan Arif, who's with Funding Tree. He's one of the pioneers of crowdfunding. Since 2012, he's been leading the charge in real estate crowdfunding, and we're thrilled to have him here today. And we have a special guest pitch hitting for us. Faith, would you like to introduce yourself?
Yeah, my name is Eve Picker, and I'm the CEO and founder of Small Change, which is a real estate crowdfunding portal.
Great, thank you so much for being here today and pinching in here at the last minute. I want to introduce this topic with a discussion of some recent real estate crowdfunded deals that our panelists have done. A lot of people have called real estate crowdfunding building an airplane while you're flying it, but I think Mark Roderick and Ryan have come up with a better way of describing it as, it's just the internet, dude, which is my favorite quote from these guys. And it really is. The principles that contribute to investing in real estate and that have always contributed to investing in real estate are still there, even if the crowdfunding platform is the way that those investments get done. And those are value and trust and confidence and transparency. Michael, would you be so kind as to tell us, first of all, about what you're doing at Origin? And I was thrilled to see in July of this year the closing of Fund 3 at $150 million, and I'm sure that was a great landmark for you guys. So just tell us a little bit about Origin and that deal, if you wouldn't mind.
Yeah, I'll give you a little bit of brief background on us. I'm one of the principal and co-founders of Origin Investments. We are a Chicago-based real estate investment firm, and we have been around for about 10 years. So we were formed in 2007, and my partner and I originally founded the firm because, we got bright lights and loud noise here. We really wanted to create an investment firm in 2007 that was centered around the individual investor and, more importantly, us, our capital. And when we were looking to invest in real estate, we had done a lot of stuff on our own prior to that, and we invested with others, and we just felt there had to be something better. And our goal was to institutionalize the process, but really focus on the accredited investor market, us, our friends and family, and that's really how we launched the firm, and that's been the ethos of Origin ever since, and why we started the firm, and it drives a lot of our decision making. I think that's an important start. Today we have 19 team members, great people I work with. It's fun. I heard Marcus Lemonis talking about people, and we have a fantastic team. We have 4 offices around the country. We have $700 million in assets under management, and we have grown exponentially in the last 3 years because my partner and I, we decided that we really wanted to be driving this bus when we saw what was happening in the crowdfunding landscape, and we made a substantial investment in technology and digital marketing about 3 years ago, and that has helped us grow from 65 investors about 24 months ago to nearly 600 today. So we've seen rapid, substantial growth. It's been fantastic. And what Mark was talking about, it's the internet, and that it just makes sense. And I know that there's a lot of firms sort of sitting on the sidelines. If you have a great story and you tell more people, I don't see it as selling so much as you're inviting people in to partner with you on your deals, and it's really been a great opportunity for us. And what Mark was talking about our fund, and I'll go into a little bit more depth, is we just got done raising our third fund. It's a $151 million value-added fund. It's 100% high net worth, and we were recognized by Forbes magazine as having the largest 506c raise in the country. So it was a great anecdote to have, and I'll talk maybe 2 minutes just about how our platform is unique, to give you some details there. But we are a fund manager, and that's how we've always operated. We've had 2 very successful funds. We had one in 11 and 13, and both, in terms of performance, ranked in the top 10%. So our track record has really helped bridge that, the trust that you're looking to build on the internet. It's difficult to build trust through digital marketing. So when you have a great team and you have a great track record, it helps quite a bit. And that helped us launch Fund 3. So we are not a firm where you come and you build deal by deal. We've never been like that. We've always been a fund manager. And what that means is that you commit to our fund, we build you a portfolio, we make all the decisions. And that brings me, my next point is, we are the operator. We're not a middleman. We don't raise capital for other people out there. We are the ones making all the decisions about the real estate, what to buy, what price, how much leverage, when to sell, portfolio construction. And I think that is something, this direct relationship with the sponsor has really resonated, and that's kind of where we see the market having moved to in the last couple of years. And lastly, we have, the last thing is we have a 10-year track record in a market that's 5 years old. We, I think, recognized early on as a true real estate investment firm about the potential in this market. And so we embraced the crowdfunding and the internet to get our story out there, and it's been fantastic. So that's a little bit about us. We're also going to announce a real estate income fund. To date, our 3 funds have focused on growth, and we're going to announce that. Apparently, I just did announce it, but we're going to bring that out to the public in the next couple months. But we're in the chart. But I'm excited to be here, talk about crowdfunding, answer any questions that sponsors, investors have about us. Right now, the way we operate, we are only accredited investors. Our minimum is $100,000 in our fund, so we really cater to a much higher net worth investor. And the only reason really is because of the costs associated with us going lower than that, and I can get into that a little bit more. We'd love someday in the future to go to the non-accredited market, but for today, it's strictly accredited. So thanks for having me.
Thank you again, Michael, for being here, and thanks for that description. One thing that struck me when I started learning about Michael is they raised $10 million in the first week of getting into this space, and he's too humble to pound his chest on that. But not only are these guys raising record amounts in record time, but the trust and transparency that we're going to talk about more in a bit, you'll see from this company and Michael and his company, they do road shows, that they have these personal relationships in this investing, which lifts the veil a little bit on some of the mysteries of an internet-based investment. So we'll get into that a little more, but Michael, I want to congratulate you again on that. I also want to get a little background and introduction from Rayana Reef of Funding Tree, who's the CEO and founder. They were founded in 2012. And in 5 years, they've funded $250 billion, that's billion with a B, in assets. And we're going to be hitting on some of those same themes of trust and transparency. But Rayan, if you could just give us a little background on how you've structured Funding Tree and built it so quickly.
Yeah, so thanks for having me. And just as a disclosure, we haven't funded $250 billion.
Don't announce that your moderator is a liar. Announce big deals.
$250 billion is the amount that's actually been raised in crowdfunding over the last 3 years, and it's been the fastest growing segment, and that's within the real estate sector. We've obviously been part of that, so just want to clarify that. So Funding Tree essentially is a conduit, has been a conduit in between bringing real estate companies and the crowd to the marketplace. So what we've done is we've helped to facilitate the marketing of that aspect. We are essentially a fundraising platform, and we're more recently switching.
I don't know if your microphone's on. You want to try that one? Try that.
Can you hear me? Okay.
That's better. You got to repeat all that.
Did you get the part about the $250 billion?
We don't need to repeat that.
Yeah. So essentially, as I said, Funding Tree has been a conduit for fundraising. We've helped companies, such as Origin Investments and other companies, go to market and meet the crowd. And we help to facilitate that through our, various, from digital media to, setting up personal connections. what we've seen in this industry over those years is exactly as Michael said, that, you know, it starts with the internet, it starts with a lot of marketing, but ultimately the fundamentals still come to fruition, and that is you have to meet people face to face to try and raise money. And that's where, you know, we've come in and done that quite successfully. And then more recently, we're now focusing much more on moving towards some technology that actually we believe will change the industry and change the real estate landscape dramatically, and that's blockchain technology. I'm sure you've heard a couple of speakers talk about this yesterday. I think it's a very important sector in real estate, and that's what we're moving towards.
Thanks, Rayana. We're going to talk a little bit later about the specifics of blockchain and how that technology can help both investors and funds manage their risk and challenges. And I want to introduce again Eve Picker, and I literally am meeting Eve now. She was so gracious to step in for a panelist who wasn't able to make it at the last minute, and I'm sorry I don't have a better introduction for you, Eve, but I can't thank you enough for stepping in and serving on this panel so we can have a full presentation. Why don't you tell us a little bit about what you're doing in the crowdfunding space?
Sure, but can everyone hear me? Okay. So, you know, what I really love about securities law and the Jobs Act and crowdfunding is the amazing creativity that has come out of it. I think there are many different platforms doing very many different things with these three regulations, and I find that really interesting. So I think I'm probably the idiot on the stage that would like to cater to unaccredited investors. I mean, that is really our goal, and that's why we went into this business. Small Change is one of the 29 funding portals regulated by FINRA. So we are permitted to use regulation crowdfunding, and that has always been our goal, to raise funds for real estate projects through everyday people, anyone over the age of 18. And the way we came to this is really my background as an architect, an urban designer, and real estate developer. I have sweated through many deals in underserved neighborhoods, in cities that needed change, and been unable to find financing. I mean, I really honestly believe that banks are squashing the innovation out of cities. So I see crowdfunding as a tool that can be used by an amazingly creative array of developers who are pushing forward sort of the next frontier of development in places that need it. And so we want to step in and provide equity for young developers who can't raise enough, or mezzanine debt, or whatever they need to make those projects happen. And the other side of it is I've spent a few decades now in Pittsburgh, unexpectedly, but it's a city I've really fallen in love with. And what I learned there is that cities like Pittsburgh that are trying to come back have really strong communities of people who really want to be invested and want to be engaged in their city. And I really believe that this is a way that they can participate. So for that reason, I would like to be much more focused on regulation crowdfunding. It is a difficult regulation. We're sort of through the worst of it and starting to put out deals. There's smaller deals, there's more investors. But honestly, I'm just in love with it. I'm in love with the idea.
Thank you, Eve. And I'll confess to a bias. We're all big fans up here of crowdfunding. You're not going to hear a lot of criticism. But before we get to some of the risks and challenges, why don't we talk about, why do we believe in crowdfunding, and why is it superior to alternative forms of investment? And I'd be interested in your views on that, because I think we all share that view that it poses a lot of advantages to investors. And maybe we'll start with you, Michael, and tell us why.
Yeah, the question is, why is it superior as a way to crowdfund? I mean, the internet has no boundaries. I mean, it should just, I think, intuitively make sense. When you think about the way my partner and I used to fundraise, there's only so many meetings he and I could have in a week. And they were, we would have to resort to our network and our network's network and, constantly asking people for referrals, and that's just not scalable. Crowdfunding allows you to scale. And again, I said this in the opening, but if you have a great story and you share it with 100,000 people, 500,000 people, you are going to get more investors. And I think we've all seen that there's an enormous appetite out there for real estate. It's sort of that that third asset class that belongs in your portfolio, but advisors and wealth managers have never really found a way to access it in the same way they can access stocks and bonds. So individuals have always been forced to go out and build their own real estate portfolio. And I think what we've seen now in the market are just so many choices and the ability for people to do that outside of their wealth managers, either doing it direct or investing with companies like us, or going and doing deal by deal at other companies. From the investor standpoint, and the other thing it does, when we think about it, we made a conscious effort to go into high net worth. It diversifies our capital base, and individual investors tend to be a little bit stickier. And if we raise $150 million through 5 pension funds, it's very different than raising it through 600 individuals, because at any one point, you're over-diversified, your base. You've got too much concentration with your customers. So, we like the idea of having a lot of customers. And then from the customer standpoint, it's choice. They have choices that they just didn't have, and they have that direct relationship. And the transparency in the market has never been greater, which is also driving down fees and costs, and driving up quality as well, and really weeding out the market. As I say, 10 years ago, you're going to laugh because you think, well, the old rules where you had to, do everything behind closed doors and quiet, and you couldn't talk, and it just seems so backwards when you see what's going on today, and the ability for people to interact socially on the internet and talk about deals and market deals, and it makes intuitive sense. And I think it's a great step forward that the government has made. And I always say, Madoff couldn't exist in this world today, given the transparency. We can't take a step without all of our investors knowing or understanding. If we miss a step, they come back and they talk and they know, and we get emails, and they talk amongst each other. So I think it's a great step forward, and it benefits both sponsor and investor.
Thank you, Michael. And to that point, a lot of people have said that crowdfunding is the democratization of real estate investing, and I think that's really true. The openings for investors, sitting at home in front of your computer were not available to individuals even 10 years ago. And although the Jobs Act was enacted in 2012, it's just been a minute in terms of this. And to you, Ryan, given the relative newness of crowdfunding and in real estate, where do you see crowdfunding in real estate going in the next 5 years?
Crowdfunding, as far as for real estate, I think that's one of the reasons why we focused on it is not only because of our own background, but that's where we saw the biggest success stories, the biggest amount of traction. And I think part of the reason for that was because real estate is a tangible asset. Everybody understands. Everyone understands what a multifamily apartment is. You interact with these things on a daily basis. That's where we've seen the most of the success stories. And what was the second part of your question? I'm sorry.
Well, I was interested in how you see real estate crowdfunding in the next 5 years and where it's headed.
Yeah, so we've already seen, this landscape beginning to take shape. It started off with hundreds of platforms all looking to put hundreds of deals. We pretty much believe from the beginning that crowdfunding has a big role to play, and the way it's going to be played is that individual sponsors or real estate companies themselves would actually take the lead, and we ended up playing a role in helping them take that lead. We see that as a future where more and more real estate companies start to expand their investment portfolio to everybody out there. That's still, I would say that's still very small as a percentage. There's a number of fairly big companies that are out there that should be doing this, although Michael would prefer that they weren't doing this, but I'm sure they do need to come out and start expanding their portfolio, because they still work in this little private world of investors. Just because they can raise the money through their private institutional investors doesn't mean that they should be just doing that. So more and more of these companies need to come out. I see that as the future. I still believe that we're a long way away, and we should actually stay a long way away from everybody's thinking that they can raise money through the crowd. In these 2 years, we've seen a number of companies come forward to us and say, oh, now that we can raise money on crowdfunding, can you help us? No, we cannot help you. We're not going to help you. Crowdfunding isn't the equity of last resort. It is a great place to invest, but the fundamentals are still the same. So we still see a future in that. Okay,
thanks so much, Ryan. Eve, I want to ask you, from your perspective in Pittsburgh, what do you see the primary ways that crowdfunding companies can help minimize risk to investors, and what are the steps that you take to help minimize that risk and ensure transparency?
Sure, but to be clear, while we're based in Pittsburgh, we actually have team members everywhere, and Pittsburgh is perhaps not the front runner in deciding to use crowdfunding.
It's a pleasure getting to know you up here in front of everybody, Eve.
But that's where I am. It's hard to know where to begin. I mean, due diligence, vetting projects is really, really important, and having consistent, high-quality projects is really, really important. And I'm personally disappointed with some of the aspects of regulation crowdfunding which don't permit us to help issuers put those disclosures and offerings together. We're not supposed to help write them. And so I think there are some things in the regulations that are stopping it from being as good as it can be. I know that with regulation crowdfunding, it was supposed to be a 3-year trial, and the SEC is going to come back and hopefully improve it. So my hope is that we're gonna see a more streamlined legal process that makes it easier for people to raise funds this way. Doesn't mean that there's going to be worse deals. I think there's going to be better ones. All of those things. But I do agree with what you were saying, that we're seeing a lot of developers coming to us thinking about it. We have a very big pipeline of people thinking about it. They know it's happening. They have private investors. They're not sure they need the money yet. They feel like they should be involved. They feel like they might have something down the road that will merit them being involved. They understand the marketing power of it, all of those things, but they're not quite taking the plunge yet.
Do you see a lot of these developers jumping in the pool, for lack of a better word, and getting over that reluctance and skepticism?
There's so many different types of developers. So the developers we're dealing with are developers who are doing interesting, quirky, edgy little projects in places like the Hudson River Valley or New Orleans, and places where other people haven't gone before. So they are less likely to find traditional financing. So they are more likely to take the plunge versus a Dunkin' Donuts in the suburbs. This probably doesn't need to raise funds through crowdfunding.
One more question on this kind of forecasting for you, Michael, before we turn to some specific risks and challenges that I want to discuss. Who do you see as being the winners and the losers in this space in the next 5 years or so? And I think you've thought about that, and we talked a little bit about it before, and I think that's going to be helpful for our audience to hear.
Well, I think over the last 5 years, especially when crowdfunding first came around, it was all about access, and that was kind of the novelty of it, and those were the firms that were providing value. And I think that the market has matured, and now what you're seeing is much more established real estate firms like ours who've been sitting on the sideline watching coming into the market. And I just read Blackstone, 10 to 15% of their assets under management are through retail investors, and within 10 years, they want that to be 50%. So you're starting to see the big boys come into this market and take note. And you know, it's a little bit different because crowdfunding isn't so disruptive or transformative where the young companies disrupt the established companies. You know, it's more of an add-on to an existing platform. So for us, it just accentuates what we're already doing. And I honestly see like the existing platforms out there, the existing real estate investment firms push out the early ones. And the reason why is because they have the 10, 20-year track record, they have the funding, they have the balance sheet, they have the teams, they have the things that investors look for, and that's really what we've seen. And investors more and more want that direct access. They want to know that they're dealing with the sponsor, the person making the decisions, and the middleman and people who are taking 5, 7, 8 cents out of the the chain. They're very aware of those. I mean, even when they're coming direct with us, we get a lot of questions about fees, and we're not the low-cost provider, and we make no apologies about what we charge, but they focus on these things a lot. So I can't imagine the conversations that are happening when you have 2 layers of fees between the investor and then the sponsor, and then or the manager and then the sponsor. So it's going to go more and more direct out there, and we see institutions now who we get calls from about what are we learning out there, what are we doing, and honestly, like, the market is so big out there, we really welcome people coming. I think that we stand out in a market, and we've seen the early adopters and maybe the innovators come into this market, but not even a tip of the iceberg for the 10 million accredited investors who could be investing in this market are here today. So I think that we are in the beginning stages, of I don't know if it's first inning, second inning, but we're early. So we're excited.
And as an outgrowth of that, how much value do you believe it adds that Origin stays in the deals? There are a lot of players who will set up the deal, take a fee, and move on. What's the value to the investor of that perspective that Origin brings?
So we had a roundtable when we were first considering even going into digital marketing, and we brought in high net worth, ultra high net worth investors, and we had a third party run it. And they were talking about investing online, and it kept, we were testing all these different ideas. Do you want like a club type, where it's stand behind the velvet rope, and they all thought that was kind of bullshit. And they kept going to, look, we have full-time jobs. We don't know how to evaluate deals. If the sponsor is putting money into the deal, and a significant amount of money in it, and that's good enough for us. And it kept coming back to alignment, skin in the game, and how much money the sponsor was putting in, because a sponsor can put any deal in front of you and they can make it look as good as you want, but you have to understand their motivations for why they're investing. Are they investing because they're trying to generate fees for themselves, and there are fees in every real estate deal, or are they investing and are they aligned with you where they make money with you, and through their investment and then through their fees when you win, they win? And I think that's what came up through this roundtable. And when we're talking to investors out there, that's what gets them comfortable with ours, is the commitment my partner and I have made to each and every investment. And we're still the largest investors at our firm today, and that gets them over the edge and gets them comfortable right away that we're investing side by side with them. And my wife's in the fund, my mom's in the fund, everybody, my family. I think that even gets them more comfortable.
Thank you for that, Michael. I want to segue now to some of the risks and challenges that this technology presents. And Rayan has a great explanation of blockchain technology, which I find fascinating and admittedly don't know that much about, but I think it is an exceptional vehicle to use with technology, helping build trust and kind of recreating those relationships that we think about traditionally in real estate investing, where you're sitting across the table from a broker or somebody that you're dealing with. And I think blockchain technology is going to help a lot. And then I'll ask the other panelists when Rayan is done to talk about how you can use technology to build that trust and that transparency.
Okay, well, thank you. So, blockchain technology for us, really a light bulb went off about 2 or 3 months ago. We've been looking at, from the beginning when we launched Funding Tree, was to try and figure out how to improve the process of making funding much more streamlined, with a greater degree of certainty. One of the things we found, the people that were looking for funding always complained that we cannot find the funding. The people that can fund deals always said, well, the deal quality is poor. We have to look at 200 deals before we can fund 2 of them. What we found with blockchain, and after we started looking at it, and this is really because, I myself was involved in a couple of other ICO-related, blockchain-related projects, and as an advisor. And then when we started looking at the technology, it just seemed perfect because one of the things the blockchain technology does is it can authenticate something. It's original. And it's the technology that underpins Bitcoin. Now, whatever happens to Bitcoin in the future, whether it goes to, 10,000 per one, or one Bitcoin worth $10,000, or whether it crashes, it's irrelevant. The technology is there. It's working. It's been working for 4 or 5 years, and it's working worldwide, and it's transforming currencies. So I see that potential happening in real estate. Real estate, to me, is perfect for this, because you have transactions, you have documents, you have ownership, you have title transfer. Every one of those are layers that you could build on blockchain to create greater efficiency, much more trust. Imagine title transfer today has to rely on, 4 or 5 day process and a lot of back checking and verification, and then you rely on the cities to record these titles. And then maybe, 3 years down the road, you find that, those documents, somebody sues you because there was some fraud committed or something. I think blockchain has a potential to eliminate all of that, eradicate all of that. And I'm sure, years down the road, somebody will find ways to, break the code on that as well. But right now, we think, there are huge implications for real estate, and we're just scratching the surface. The best way I can describe it is, the internet 20 years ago, we didn't know which way it was going to go, where it would be used, and everybody was trying to work out how it could be used. And we find that if we break this down into layers and start looking at all the different aspects of a real estate transaction, we can start to apply some of those layers in blockchain.
Well, as a real estate lawyer who's seen, tables full of closing binders on a lot of closings, I'm really fascinated by the use of blockchain technology and other technologies to cover those same bases and ensure that investors and participants in the deal are protected, while also streamlining things. Michael and Eve, what are your thoughts on the ability to harness this technology in the crowdfunding space in order to minimize risk?
We're not looking at it, I can tell you that right now. And I think with the United States, when we think about how blockchain technology will impact this, it'll impact it at the margins, right? We have a title system that works here. But what I was thinking about is, how is this going to impact the rest of the world? Because there is so much capital around the world that's looking for investments, and you have no safety or security, especially in these third world countries. And you've seen what happens in Venezuela, right? They don't have a banking system anymore that works. There's no trust. Or in Africa, and those are the ones who are really adopting the Bitcoin and these other cryptocurrencies because they don't trust their governments. We have a system that works. We also have a title system that works, but that's not true of other countries out there. So where I see blockchain and the crypto market really impacting is in the third world. That you are going to see, once they figure out their title, because I have friends, they bought property in Mexico 30 years ago only to find out that it was resold 5 times over, and they don't actually own it because the title system down there is so screwed up. If they can use this ledger system to make everything visible and have confidence in the title system down there, you will see money start to flow into these other countries. But right now, it just doesn't exist. And I don't think it's going to be as transformative to the United States in either our currency system or our title system. It'll enhance it, but I feel pretty comfortable that when we go to the title company, we buy a property, the next day I own that property and nobody's going to show up and tell me I don't. But I do not feel comfortable investing in Costa Rica or Mexico or Bolivia or any of these other places out there. But I think blockchain technology will completely transform the rest of the world.
Thank you. Eve, what are your thoughts on blockchain and technology in this space and the benefits and burdens of it?
I am not a blockchain expert, but I certainly think that if you do something like a Regulation A or Title IV offering where you have thousands of investors and perhaps you have convertible debt, tracking that is really, really complicated, and it seems like blockchain could be very, very useful for that. We know that transfer agents used to be really, really expensive. You still need them for those processes. I think that eventually they may be eliminated through technology like that. So I just don't know enough about it, but I know that there are certainly points of friction in what we do where new technology would be helpful.
Okay. Eva, I'm going to stay with you, and then I'm going to ask Michael you to opine on the same question, another related question after for you, Rayan. But so I'm considering an investment. I've logged onto my computer, and I come to one of your websites, and I have some questions. What are the questions that a non-expert, inexperienced real estate investor should ask? And secondary to that, how do they get that information? Sitting there in their bathrobe going, you know what, I want to be a real estate crowdfunding investor. What are the questions and how do they ask them? Eva, would you mind starting?
Okay, sure. Well, it depends which offering it is. Okay, if it's a regulation crowdfunding offering, we are required to provide a communication channel on the funding portal, on the electronic portal, and we're not even a moderator. We just provide that outlet. Investors talk directly to issuers or to employees of issuers, and they have to identify themselves so that investors know who they're talking to. So there is a direct line of connection to the person who is raising the money. Regulation D, because we are not broker-dealers, we don't want to appear like we're giving any sort of investment advice. So we don't have those conversations online. But people will call us and ask us to specify the terms of the deal a little more clearly. We provide a lot of information online, so that's actually pretty rare. With regulation crowdfunding, we're not permitted to talk to investors, so they're really different. They're really different animals, and you'll get a different response depending on which offering it is.
Michael, what are your thoughts on that?
Over the years, we've gotten some really, really great questions from investors, and most of them pertain about the deal, the assumptions, things like that. And then other investors really dig into the platform, and they want to know even about my partnership with my partner, which matters when you're in a partnership. And they ask about the viability of the platform, and they go deep there. And we've even had investors who, please don't, our ex-employees are getting driven crazy. But I thought this was a really cool tactic. One of our new investors, in order to do due diligence, he called one of our ex-employees. And we have a great relationship with our ex-employees, but he, you're going to get pretty good information from somebody who used to work for the firm. And so, a lot of it is about the deal, and I think that's great. And you want to literally read between the lines and make sure that what you're reading, what they're saying, there's no red flags there, and that you're comfortable. Because at the end of the day, this is a partnership, and you're hiring these people, and you're going to have to live with them for 5 or 6 years. And you have to look and ask them about their worst deals, their best deals. Certainly, if they've had any lawsuits, you'd be surprised. I mean, what you can find on the internet these days just by Googling the names of the principals, and that's like the basic thing to do. But just dig in, have a conversation, and see if it's a fit. Because there are so many opportunities out there that if it is not a fit, go to the next one. There is always another bus or train coming by, and just find somebody who you think is going to represent your interests, make good decision making along the way, and be a good partner.
And I think that emphasizes once again the old values of transparency and comfort level still apply, even though you may be harnessing some technology to facilitate this investment. Now, Rayan, you have an interesting and unique perspective with Funding Tree and connecting some of the players in this industry. What are some of the things that you've seen that you find work really well in providing the investor that great level of transparency and comfort, and some of the things you've seen that you might caution folks to run away from if they encounter them in this experience?
Well, we try to encourage as direct contact as possible, and obviously the type of contact and what the transparency levels, how they present themselves. But we always start with don't have me sell Michael. Let Michael present what he's got to present himself. And that's one of the challenges that crowdfunding industry faced was, that a lot of these deals were on platforms. The platform is promoting themselves as having X number of deals. Their only interest in those deals predominantly is because they get a marketing fee for every deal that's on there. So it's not in their best interest to necessarily, promote Michael in the same way that, you know, they would their own offerings. So that's one thing we always try to encourage people. If you want to evaluate, you know, and then we have tried to encourage people to look at the fundamentals. The fundamentals have not changed. You know, the way we evaluate those fundamentals have changed. Yes, you can look at things online. Yes, you can review documents digitally. And yes, you can look at people as far as, you know, the social media conversation. That's a great way of, you know, learning about people, to see how genuine they are, you know, what they do around the cities, what they do in their communities. All of that comes into play. So those are some of the things that we tell people to look at. But at every opportunity, if we talk to a sponsor or real estate company, we try to encourage them to tell their story, not let us tell their story. And then likewise, we try to encourage investors to have, at every opportunity they get, to speak to the people, to meet with them, to, you know, whether they're doing road shows or whether they have to go to their offices, you know, meet with them, sit down with them. That's the only way. I would not part with a dime of my money without meeting the person I'm giving that money to. And I'm involved in crowdfunding.
Thanks very much, Ryan. I've found it interesting that there is so much access and transparency to the good providers in this space. And I think if it's harder to get a hold of somebody you're thinking about investing with than it is to get the cable company to come out and fix your cable, then you should probably move on to the next platform. And that's consistent with what these guys are saying. So one last just forecasting question for the three of you, given your perspective on where real estate's been, where it's going. We've seen, 5 years plus of market growth in real estate. Certainly, as a California real estate lawyer, we've seen that at Allen Matkins. What are your thoughts on where the market is going generally, and if it's still a good time to get into real estate? And what any particular segments you like. Let's start with you, Michael. I think this is a subject near and dear to your heart.
Yeah, I always think it's a good time to be in real estate, and I've been invested in this asset class for years. I think it's like anything else. You know, if you've made a lot of money over the last 5 or 6 years and it's a large part of your portfolio, take some chips off the table. Everything is cyclical. Stock market, real estate market, bond market, these things move up and down. But I don't have a crystal ball any better than anybody else in this room has. And what we look for is just good relative value in the market. And it's certainly much more difficult to find deals today than it was 5 or 6 years ago, but they're out there. You just have to look a lot harder, and you have to use the best decision making you can. But I can't tell you if 2017 is going to be a good vintage or a bad vintage. We're not going to know that for a couple of years. But we are going to continue to exercise discipline in every market, continue to buy deals. And you know, it's funny because you talk about a real estate market, but real estate is so idiosyncratic that when you look around, even in bad markets in 08 and 09, I know people who did fine. They delivered projects maybe a little bit late, they met their pro forma, and you know, it really comes down, you know, the vintage explains about 60% of your return correlation, and manager and other issues are the other 40%. So, you know, what Mark has talked about resonated with me, which is the top of the pyramid is the people, then the product, process, and then product. And you have to know who you're investing with and make sure you spend time there. Real estate, though, is always a great asset, and just make sure that you're truly looking at downside and you're stress testing and making sure that if there is a 2 or 3 standard deviation, that you're going to be able to withstand that. And you're buying quality real estate that can go through the other side, because most of the real estate went bad. These were ill-conceived business plans. These were assets that were, they were over-levered. These were sponsors that didn't have a balance sheet. So there's a lot of reasons why assets really deteriorated in 08. But we forget that plenty of people, you know, who owned assets in 07 and who were able to ride through the other side did just fine. So you have to have a long-term outlook. Should always be exposed, but if you've done well, take some chips off the table.
Thank you, Michael. Eve, what are your thoughts?
Yeah, so only about 3% of the population in the US is accredited, and I suspect that's a little weighted in this room, but that means the vast majority of you sitting in the room are not able to invest in most of these offerings, and that is the dramatic shift I think we're going to see. Hundreds of millions of non-accredited investors are going to be able to invest in real estate for the first time. They're going to be able to expand their portfolios beyond, you know, bank loans that pay miserable interest rates or mutual funds and participate in investing in real estate deals in places that matter to them, or perhaps in business deals. And I think in 5 years, we're going to see an enormous amount of people involved who've never been able to be involved before, and I find that incredibly exciting.
Rayan?
So, I think I want to touch on both the points that Eve and Michael made. So, Eve, and I totally agree with you that, there's 8.8 million accredited investors, and currently there's about 200,000 people that actively invest in real estate out of those 8.8 million people. We know this to be reasonably accurate because we track other platforms, and every one of them talks about having about anything from about 150,000 to 200,000 subscribers. So I think we're a long way even to tap into the 8.8 million people. What I've found that so many people still don't know about crowdfunding, don't even know what an accredited investor is, but the numbers are out there, and those numbers will continue to grow. So they will add to the pool of investors that Michael is working with. But if we expand that to the new investors, the Regulation A investors, which is everybody, and that's over 300 million people, I think that will take time, that will take a lot of traction, but there is a viral nature to this, in that I don't think we could predict how quickly that could happen. But what I think will need to happen is that we will need to have a few very strong companies that stand out from the crowd as being absolute leaders in crowd investing. And a good example, I would say, for example, Realty Mogul are here. They've already started 2 or 3 funds that are catered towards Regulation A. They have a pretty good track record so far. I see them as leaders in that particular field. There's another company called Fundrise that handles those funds. They're able to attract a lot more investors. Until some companies that are starting to rise above everybody, they have a good, they've built a track record, there's a certain amount of trust built in them, then the numbers will grow. I have a slightly more controversial view. I don't think that having a platform with lots of deals will help to fuel that. I think having a platform with some solid deals and sponsors managing those deals will help to fuel and grow that number.
Thank you all for your responses on that. I want to talk about hidden risk. And I want to ask Michael and Eve to opine on this, since you occupy kind of similar space but different. How does a potential investor identify or illuminate some of the hidden risks, and how do they go about getting that information? Michael, I'd like to start with you on this.
Yeah, well, we were talking about iFunding earlier, and I'm not sure how many people have heard about that, but they had 400 investors, and they just basically became insolvent last month. So these investors are a little bit up a creek right now. It doesn't mean that the investments went bad. There's just no manager, because they were one of these organizations who were a conduit between the investor and the sponsor, and they were a middleman taking fees, and they just couldn't make it work. And so, that's that's one of those hidden risks that maybe people, when they were investing here, they were looking at the deals and things like that, and they didn't ask about the viability of the platform. I view that as a hidden risk, and somebody's now got to manage those deals and charge for those, and I'm sure they're going to charge quite a bit. So we don't know how that's going to end up, but I'm sure that if those investors had a mulligan, they'd probably take it at this point, and they wouldn't invest. When I think of hidden risks, it's sort of like all those things that everything goes right and you still don't make money, and maybe, it's the way that some of these PPMs and the language is created that might be a little bit confusing. Fees are a big thing in there, and when we talk about this, we put our fees right up front and center, and it caused a lot of questions in the beginning, but there's an education process on the beginning. But many sponsors out there, they look at, they'll take 1% on NAV. And if you look at NAV, then you have to go in and you have to find a definition in the PPM. And NAV could be one of two things. It might be the net asset value on the equity, or it might be the net asset value of the actual asset itself. And if you're leveraging up an asset on 2-to-1 debt to equity and it's worth $30 million, and the NAV definition is that it's on the total deal size, that's a $300,000 per year fee on 1%. Well, if a manager is charging 2% on NAV described as the equity in the deal, and you have $10 million, that's only $200,000. So, you got to really look, and it's, I heard a phrase that the big print giveth, and those are all the things that we see in the marketing materials that we get excited about, but the small print is what taketh away. And those are the things that are in the PPM. Those are the things that, we don't go to until we're in a lawsuit and we're looking at that. And did he have the right to do this? Did I know about this? Oh my God, they're refinancing, they're taking 5 points. They took a huge acquisition fee, they're taking a disposition fee, and it's sort of that heads they win and tails you lose scenario, which nobody wants to get into. So, and that's, even if you're reading a little bit of the PPM, the executive summary, and you're seeing inconsistencies, you have to, again, when I was talking about earlier, read between the lines and look for those red flags and trust your gut on these things and talk to former investors and make sure that, if you're in real estate, you're capturing the majority of upside, because you're investing in this and you're going to get 100% of the downside. And you don't want to get into the deals where you're only getting 40 or 50% of the ups, but you're getting 100% of the downs. That's just, setting yourself up for failure long term, no matter how good the deal looks.
Thanks, Michael. Eve, what are your thoughts on how a potential investor can ask the right questions and identify risks that might not be apparent from the big print?
So again, this is what I really love about regulation crowdfunding. We are required to write in plain English. And I think probably the biggest risk out there is I don't understand the need for offerings that are just impossible for people to understand. I think it's very simple to lay out all of the risks of investing, and there are lots of them, and they should be right front and center along with the fees. And if they're not there, I probably wouldn't invest. I think, this is the unfortunate thing with Regulation D. There is no standard format for a PPM or an offering. It's a little bit the Wild Wild West. So everyone is writing these things in a different way, which makes it very difficult for investors to navigate and compare apples to apples. And although regulation crowdfunding does have some issues, it does make that process much clearer for investors. So,
thank you for that. We're running out of time, and I want to save a little bit of time for questions. But I would ask just briefly, each of you, what are your views on, in the wake of the iFunding news? What is one bad actor in this industry do, and how do you guys communicate to mitigate that impact to investors?
Well, I think, it's inevitable that, an industry that's relatively new, about, 4 or 5 years old, that you are going to hear stories and you are going to, have this thing happening. I think Brock Pierce, who was speaking about blockchain yesterday and Bitcoin and the whole technology, I mean, he did, he covered some of those topics yesterday, and that was that, just because something goes wrong doesn't mean everything's going to go wrong. And he covered some topics, for example, in the banking system today, we have problems with fraud. We have things going wrong at a major scale where banks like Wells Fargo are involved. That doesn't mean the entire system is fraud. Yes, on a percentage scale, with only a handful of people, 1 is a big percentage number. So, people need to be aware of those things. We are exposed to it more. We do see it more. We also see right now in the industry who should be out there and who shouldn't be out there. And I think, we try to discourage people when we know something about a particular company. We do our best to warn them, to guard them against that type of thing. And again, it goes to my own personal point of view on various platforms that are out there. A lot of these platforms are very self-serving, so people have to ask the right questions. People have to ask, how they can, what's the difference? I mean, that's one of the biggest questions we get asked is, what's the difference between, Michael's platform, your platform, and Realty Mogul? And I think it's important for people to know the differences, because risk plays a part in how deals are structured on each platform. So it's inevitable, it will happen, but again, people are responsible for trying to educate themselves, and we're here to try and educate them.
Michael, what are your thoughts?
We have the distinct advantage for having 10 years behind us. So I think it's easy for investors to look at that we've, behaved reasonably over that time, and they can do that due diligence. It's much more difficult for newer firms coming up. And while I think most of these platforms have good intentions, there are some platforms out there who are looking to fleece investors, and I don't think they have any qualms about it. And I'll just share a story with you because, it was about a year ago, we were doing an event in LA, and somebody signed up for it, and Ben, who's with me today, did some due diligence, and he went to their website, and their website was our website. Literally, everything. And I'm not talking about the kind where you're flattered because they stole your design or something like that. Like, they took our track record, they took our Q&A, they forgot to change names in here, everything. And we're looking at this, and they had deals up, and they had our slogans, and Ben had an awkward call with the guy. And our counsel ended up sending them a cease and desist letter. They're still up today, operating. They have deals on their page, and I would bet, right? I'm not going to guarantee, but I will bet that those deals are not real. So you have to be careful when you're out there, because there are people, there are just bad people out there in every industry. And with what's happened in crowdfunding and what's going on in the ICOs, we've heard about fraud there. It's unfortunate. So it's buyer beware, do your due diligence. Again, it comes down to people. Make sure you know who you're investing with. Don't fall for the returns. Don't fall for that mistake and chase big returns. The worst deal I ever did was a 30% IRR, and the best deal I ever did was a 16% IRR. That's how they started out, but I can tell you they didn't end that way. So that's my thought on that. But
Thanks, Michael. Eve, anything to add, and then we'll take some questions?
I'm sorry, say that again?
Do you have anything to add on?
You're just echoing a lot. Yeah, I do. So I think Google is a wonderful thing. You can figure out who the founders are of this company, who's running it, and Google them and see what their background is. And if you don't like what you see, then you shouldn't invest in them. I mean, I think what Marcus Lemonis said before is exactly right. You should like the companies that you deal with. And it's pretty easy to do research on people these days. There's lots of ways to figure out whether you want to do business with them.
Thank you, Eve. Any questions from the audience for our panelists? Right there. Yeah.
Could you comment a little bit about the cost of raising money? And maybe that's why your minimum is $100,000. And because I know the question about how much should someone expect?
yeah, well, I'll put it. I think the first Tesla.
Use the microphone.
Sure. Yeah.
Extra mic here?
That one's not working. The question was the cost of fundraising. Our minimum is $100,000. How much did it cost? You have to remember, the cost today is much cheaper than when we got in. So we started around 3 years ago, and we built our technology from the ground up. There was just no technology that we saw that really fit what we were trying to do. And like a Tesla, the first one that comes off the line costs $1 billion, right? So your first customer is going to cost you quite a bit of money. Now, technology today, you can leverage it. There's all these platforms out there that you can rent it pretty cheaply. You have to, though, spend money on digital marketing, and that's expensive. I mean, you can throw money literally out the door. You have to do content. We have an entire now marketing department, investor relations department, because even once you raise the money, then you have to service these investors and make sure that they're happy and that you're communicating with them. So, for us, it was in the millions of dollars, and we have dedicated and devoted a substantial arm of our business of this today to continue to move in this direction. But we firmly believe in it, and we're going to continue to raise capital here. On a percentage basis, I would think it's a heck of a lot cheaper than paying the broker-dealer market on that side, but not in the beginning. You have to have really, I think, a 5-year vision here and be able to fund it up front, but also have a good story. If you don't have a great story and you're not really, willing to commit here, you can try to go in and peek your toe in, but, it's easy to throw a few $100,000 away in this market.
Okay, we have
I don't know if that
question.
answers your question, but happy to talk to you about it more.
Hi, good afternoon. Joseph Landisman with Lloyd Jones Capital. Question in regards to marketing. Your Origin's biggest one, and it's awesome, and everyone knows about it now and before. But do you know any marketing firms in this space for people who are looking to actually start in the similar space?
Yeah, you can address it. So let me just say, I'll just tell you who we use. So the question is marketing firms, and Rayan's going to pitch his funding tree in a second. We use RealCrowd, and we like them as a listing service, so we've used them, and that's a really inexpensive way to enter the market. What RealCrowd offers is they're a listing service, so they're not a conduit or a middleman between the broker, and then we own those relationships. So they've been a great partner to us. But they're not, and this is what investors have to be careful of, they are not recommending deals, they're not doing their own due diligence. So when you go up there, everything up there is just what the investor says. So they're not curating or rating deals on there. But for a firm like yours, I would highly recommend, and happy to make an introduction. So.
Yeah, so I think it's really important as far as marketing is concerned, and CrowdStreet is somebody that we've also endorsed, and I would also endorse that to you. And Michael's group is a great example. They use CrowdStreet, but they're also doing a ton of other marketing. RealCrowd. Sorry, RealCrowd. A ton of other marketing on top, and including being at events like this. So, you have to think of it in terms of you need marketing support. Whether you need somebody that's an expert in crowdfunding or whether you need an expert in marketing, I would say you need an expert in marketing and not somebody who just wants to be an expert in crowdfunding and then learn some of the marketing techniques. Marketing to me is the key to reaching as many people as you need, and you need to use all the tools, and CrowdStreet definitely is one of them.
Can I? RealCrowd.
We have time for one more. We have time for one more question.
I said RealCrowd. But here's what we did in the beginning. I'll share. We really, we embarked on a full-blown marketing campaign because your front doorstep is your website. And you have to make sure that your website is tight, that everything, that you're ready to bring in 50 to 100 investors and have the technology for them to peruse. And there's so many different elements of this, and have content and education and really allow them to come in and peruse and have, so we've spent a lot of time on this, and we literally started years ago, and it's an evolutionary process, but we started from day one.
Any more questions? I think we have time for one more. If you want to.
With the fact that maybe you're not using a broker-dealer or a banking channel, do you still have the same commitment to like a third-party due diligence on your website, so someone wants to verify that all these returns are kosher, so to speak, that your background, you've done all the deals you said you did?
We don't know, not on a, so Title II, we have to obviously abide by SEC standards, and we can't cherry pick and things like that, but there's no third party that's doing due diligence. But we have all of our returns online, and we provide references and things like that. So if anybody ever wanted to qualify those returns, they are more than happy to talk to our Fund 2 or Fund 1 investors, and they can qualify them. But it's never been an issue, but I'm sure Title II requires you, to be accurate on there, and we don't want the SEC crawling down our throats. That would be the worst thing that could happen to us. We don't benefit from that.
Origin is so good, they're accurate on two websites, their own and their competitors that stole their website.
Yeah, right. Yeah.
Well, that's the end of our presentation today. I want to thank you all again for spending your lunch hour with us. Thanks to our panelists, Ryan, Michael, and Eve.
Thank you very much. Terrific panel. We appreciate everyone's